Let's be honest, Fidelity's cash management account sounds almost too good. And if you've been sleeping on your traditional bank out of loyalty, habit, or sheer stubbornness, you might want to sit down for this one. We're talking unlimited ATM fee reimbursements, FDIC insurance up to $1.25 million through program banks, and a debit card that works basically everywhere. So why does your local Chase branch still have a weird hold on you? Here's the thing though, the CMA isn't exactly riding high right now in the public conversation because most people still don't know it exists. And the ones who do are treating it like some underground financial hack whispered between Reddit threads and personal finance YouTube channels. That gap between what this account can do and what the average person thinks banking looks like is genuinely one of the more fascinating disconnects in modern consumer finance. The reason this conversation matters is that we are living through a slow, quiet revolution in how everyday people interact with their money, and traditional banks are basically the blockbuster video of financial services still standing. Still useful for some things, but absolutely not the future. Interest rates on savings at legacy banks have been embarrassingly low for years, sometimes as low as 0.01%, while money market funds and high-yield alternatives have made sitting in a big bank feel like renting a billboard for your cash and getting nothing in return. But here's where we pump the brakes a little, because for all its glory, the CMA has a very specific Achilles heel, and it's not hidden or complicated, it's just quietly inconvenient. You cannot walk into a Fidelity branch and deposit physical cash, and depending on where you live, the nearest Fidelity Investor Center might be farther than your patience can travel on a Tuesday afternoon. Think about what that actually means. For a real person, you sell furniture on Facebook Marketplace. Someone hands you $80 in crumpled 20s, and now you're standing in your kitchen wondering how to get that money into your account without driving to a third-party retailer that charges a fee to do it. That's not a deal breaker for everyone, but for cash-heavy freelancers, gig workers, or small business owners who collect physical payments regularly, this is less of a minor inconvenience and more of a structural mismatch. And then there's the notarization thing, which sounds boring until the moment you desperately need it, at which point it becomes the most urgent thing in your life. Traditional banks offer free notary services to account holders as a quiet, underrated perk. And when you're closing on a home or dealing with a legal document that needs a stamp and a witness, you'll be very grateful for that brick and mortar relationship you almost abandoned. The irony is that we spend so much time optimizing for the digital world that we forget the physical one still occasionally demands our presence in person. Historically, Americans have gone through waves of banking disruption, from savings and loans in the 1980s to online banking in the early 2000s. And every time, the narrative was that the old model was finished. What actually happened was a long, messy coexistence where digital tools layered on top of traditional infrastructure rather than replacing it, and the people who bet entirely on one side often found themselves scrambling when the other side proved stubbornly necessary. One of the biggest misconceptions about the CMA versus traditional banking debate is that it's binary, that you have to pick a team and commit like it's a sport. The smarter framing, and the one that most financially literate people actually operate by, is using the CMA as your primary hub for savings, spending, and investing, while keeping a local bank account with a small balance for the specific moments when physical presence actually matters. That's not a compromise. That's just playing chess instead of checkers. The practical lesson history teaches us here is that optimization without redundancy is fragility, and your financial life should not be fragile. Keeping $500 to $1,000 in a traditional bank account costs you almost nothing in opportunity cost, but it buys you access to services that can save you real time and real stress when the universe decides to test your systems on an inconvenient Wednesday. Moderate your enthusiasm for the new without completely abandoning the infrastructure that the old world is still built around. Discipline in personal finance is almost never about finding the perfect single tool. It's about building a system that holds up under weird edge case pressure without requiring heroic effort from you. The CMA is an extraordinary product, possibly the best all-in-one cash account available to retail consumers right now, but extraordinary tools still have specific use cases and real-world constraints that no amount of enthusiasm can wish away. Sizing your dependence on any single financial product appropriately is itself a form of risk management. There's something philosophically interesting about the fact that the more sophisticated your financial setup becomes, the more you start to appreciate simple, boring, old-school solutions to simple, boring, old-school problems. Cash is still legal tender. Notarization is still a thing. And sometimes the most valuable financial move you make in a month is just walking into a branch and talking to a human being who can fix something in 10 minutes that an app can't resolve in 3 days. Never confuse complexity with intelligence. The absurdity of our current moment is that we have access to genuinely remarkable financial tools that our parents couldn't have imagined, and yet we still sometimes need someone with a stamp and a notary license sitting in a strip mall between a dry cleaner and a Subway. That's not a failure of progress. It's just evidence that the world is layered, and smart people build their financial lives to reflect that layering rather than pretend it doesn't exist. Comfort with that reality is itself a form of financial maturity. So where does that leave you? Do you close the checking account at your local bank and go all in on Fidelity? Or do you keep both and feel vaguely disloyal to the future? Keep both, size the traditional account small, use the CMA for everything you possibly can, and revisit the setup once a year to see if anything has changed. That's not a thrilling conclusion, but thrilling conclusions in personal finance usually come right before expensive lessons. The goal was never to find the one perfect account that handles every single aspect of your financial life. The goal is to build a resilient, low-maintenance system that keeps your money working while you focus on everything else. Fidelity's CMA gets you 90% of the way there with remarkable elegance, and a humble local checking account quietly covers the remaining 10% without drama. Consistency, sizing, and a little humility will always beat the perfectly optimized but brittle setup that collapses the moment real life shows up. And if you're ready to take your financial life more seriously, whether that means real estate investing, connecting with a contractor for a home project, or finding the right lender for your next move, check out our links in the description below and let us help you get started.